So here's our question for today. Have you recently inherited an IRA account? Unsure what to do with it or how it works? Well, stay tuned as we break it all down for you today on the show.
Welcome to the Ask Ralph podcast. We're listening to an experienced financial professional with over 30 years of experience can help you make sense of confusing questions, current headlines, and industry trends about taxes, small business, financial decision-making, investment strategies, and even the art of proper budgeting. Ask Ralph makes the complex simple by sharing his real-world knowledge from a Christian perspective with all things financial. Now here's your host, Ralph Estep Jr.
Welcome back to the show on this Financial Friday. Today we're diving into the world of inherited IRAs. Now, before we get started, don't forget to subscribe to the show and join our email list. You can do that at askralphpodcast.com. You don't want to miss a thing. In fact, you don't want to miss tomorrow's episode, where we're going to be talking about the new employee versus independent contractor rule. It takes effect on March 11th. You don't want to miss this. It's a big change. Inheriting an IRA can seem complex and confusing initially. You just went through a difficult time. Someone that you loved or cared about has passed away. And there are many rules and regulations around these accounts that differ from traditional IRAs. However, if you have the right information, inherited IRAs can be managed properly to continue tax-deferred growth. So on today's episode, we'll explore what an inherited IRA is, the basics of how it works, distribution options, that's when you take money out of it, the tax implication, and steps you can take if you've recently inherited one of these accounts. My goal today is pretty simple. I want to provide you clarity and actionable advice to guide you through this process smoothly. So whether you're a spouse, child, or any other beneficiary, that's a person who is the receiver of these funds, navigating this is new territory. So let's break it down together. Let's start off by saying, what is an inherited IRA? First things first. It's simply an IRA account that has been passed on to a beneficiary after the original account owner's death. So for example, let's say that your mother has passed away. I lost my mother almost a year ago. It's a tough time. And then you compound it with these financial decisions. The beneficiary inherits the assets and gains control of the account. Now, while I'm here, I want to make sure you take note of this. If you have any IRA accounts or any accounts in general, make sure you're designating a beneficiary. I've seen this become a huge problem. In absence of a beneficiary, those IRA accounts can go into an estate, and that can trigger a huge tax consequence. So here are some key factors to consider when you inherit an IRA. The original IRA account must have designated beneficiaries on the account. So in the case of my mother, for example, if she had an IRA account, she would say, okay, on the date of my death, this IRA account goes to X, Y, or Z. In my case, it's my sister and I. So let's just use that as an example. My IRA account is to be split between my son and my daughter. If, like I said, if no beneficiary is named, the assets go to the estate. You want to try and avoid that. Now, here's an important part. Inherited IRAs maintain their tax-deferred status. Well, that's a good thing, because that means the beneficiary can continue growing the account tax-free until withdrawal. But that's when it gets a little complicated. Withdrawal requirements differ from original IRA owner rules. We'll talk about that in a few moments. So we said assets can remain in the inherited IRA and grow based on how the new beneficiary investor manages them. It's your choice. So in essence, an inherited IRA is a tax-advantaged account transferred to a beneficiary to maintain deferred growth potential. It basically remains the same as it was when the person who set it up in the first place. But then it gets a little complicated. So let's talk about the distribution rule. How do you get money from that IRA? This is where it gets complex, folks. I got to be honest with you. And it really comes down to a first decision point. The withdrawal rules vary depending upon your relationship to the original account owner. What does that mean, Ralph? Well, basically it means this. Your options differ whether you're a spouse, child, or another beneficiary. So let's talk about spousal beneficiaries first. So husband and wife, husband passes away. Wife inherits the IRA. So if you inherit an IRA from your spouse, you have more flexibility. They built into the tax code some more flexibility because it's your spouse. Here are your options. First thing you can do, you can treat it as your own IRA. You can transfer that inherited IRA into your existing IRA or roll it into another IRA. Basically, They change the name of it from your husband's name to your name. This allows you to delay taking money out of it until you reach your required minimum distribution age, which could be as high as 73 at this point. So that's option 1. Option 2, you can remain the beneficiary. If you choose to remain a beneficiary, you can delay distributions until your deceased spouse would have reached age 73. So you just don't change anything. You just sit on the money and you wait till you have to take your distributions and then you start taking them. Now, another option you have is a lump sum withdrawal. You can cash out the entire account immediately and pay ordinary income tax on it. It's not ideal from a tax perspective. Let's talk about why. So let's say, for example, in this case, husband passes away and he has a $100,000 IRA account. And the wife decides, you know what? I'm going to make it simple. I'm just going to take the money out. Well, the problem with that is now you've just injected $100,000 of income in the current tax year. That could very well put you, it probably will put you in a higher tax bracket. Not an ideal situation. So there are other options. One of those options is a 5-year payout. You have the option to empty the inherited within 5 years and pay taxes accordingly. Also, not ideal for maximizing tax deferral because you're still going to take that income over 5 years. So in our example, you had that $100,000 IRA, but you're going to take $20,000 a year. Still going to put you into a higher tax bracket. So as you can see, spousal beneficiaries have more options to continue deferred growth compared to non-spouses. So then you ask Ralph, well, what do non-spouse beneficiaries do? For all other beneficiaries, like children, the example we talked about here was when my mom passed away. If she had an IRA and she left them to my sister and I, her children, the rules are a bit less flexible. So what are those rules, Ralph? Well, let's talk about it. You can elect what's called a 10-year payout. Any non-spousal beneficiary must empty the inherited IRA within 10 years following the original owner's death. So it's basically pretty simple. Let's go back to our example. $100,000 IRA inherited by 2 children. So each of them would be entitled to $50,000. And they can take that over a 10-year period. So instead of taking $50,000 all in 1 year, they can basically take $5,000 a year, which isn't going to have a huge tax hit on them. It's not going to necessarily put them into a higher bracket. The other option you have, you can do what's called the annual required minimum distribution. So you have 10 years total to fully withdraw. You must take annual RMDs based on your life expectancy. This prevents the account from growing indefinitely. So if you are getting close to that RMD date, you may have to start taking these withdrawals anyway. Now, here's a big issue. There is no rollover benefit. You cannot roll over an inherited IRA into your own IRA. We talked about that spousal IRA where husband passed away and wife decided she would just roll that IRA money into her own IRA. Well, you can't do that if you're not a spouse. So if you're the child, unfortunately, best case scenario, you're going to have to take that money over 10 years. There's no way of rolling it into your own account and then waiting till your own retirement date to take it. So the goal of these rules is to limit tax deferral advantages for non-spousal beneficiaries. I mean, bottom line is that this money has remained untaxed and the IRS wants to get their hands on it and tax it. So you got to make sure you understand the requirements before managing your distributions. So let's talk about taxes on inherited IRAs. This is a crucial part. You need to understand the tax implications of these inherited IRAs. While they do maintain tax-deferred status until you take money from them, all the earnings in that are tax-deferred. But once withdrawals begin, taxes have to be paid. So how are taxes paid? Well, let me talk about that now. So withdrawals are taxed as ordinary income based on your tax bracket, just like traditional IRA withdrawals. So for example, let's say you have a W-2 job, you make $50,000 a year. And let's say you have some interest and dividends, that sort of thing. Well, this inherited IRA money is just going to add to what we get to what's called your adjusted gross income. So in our example, with the 2 children, they're going to have to take $5,000 a year. So they've got that $50,000 W-2. Let's say they have $1,000 in interest and dividends, and they're going to have this $5,000 IRA withdrawal. Well, the thing that's complicated is maybe that $5,000 ends up being taxed at the top rate for that particular individual because it pushed them into that tax bracket. So you have to just be aware of that. Now, if it's a Roth IRA, withdrawals are tax-free since the contributions were post-tax. So if you happen to inherit a Roth IRA, there are really no tax consequences to that. Now, How do you handle those taxes? And this is the big surprise. I talked about this in another episode. When you go to take that distribution, most financial brokerage houses are going to ask you if you want to withhold tax. And they're generally going to suggest you withhold 20%. Again, this depends on your personal tax situation. That's why I'm going to tell you to speak to a professional. If you want to talk to me, you can go to my website. That's at askralphpodcast.com/store. There you can schedule an appointment with me, because you don't want to spend all this money, because there is going to be a tax consequence, but it's going to depend on your particular situation. Now, one of the things that's very good about this is there is no penalty. There's no 10% early withdrawal penalty. Where am I getting that from? So here's the deal. If it was your own IRA and you took that money out before you reached 59 and a half, the IRS charges a 10% penalty for what they call premature distribution. But you don't have to worry about that when you inherit an IRA. Any withdrawals you take have to be reported on your personal tax return. It's also generally income at the state level. So don't forget about those state obligations. The bottom line is that inherited IRAs function very similar to traditional IRAs from a tax perspective. There's really not much of a difference. But you need to talk with a tax advisor or tax professional to determine the specifics for your situation. So Ralph, what are the action steps? You always try to give us action steps. Well, I'm going to give them to you right now. If you're navigating this process currently, here are some steps to take. Number 1, notify the custodian. Inform the bank or the firm holding the IRAs that the original owner has passed away. They're probably going to ask you for a copy of the death certificate. Get in touch with those people and get that process going. Step number 2, you need to understand your distribution options. We talked about those. Review the rules we discussed based on your relationship. If you're a spouse, there are a certain set of rules. If you're a non-spouse, there's other rules. And you got to consider the tax implications while you're there. Now, here's a step that a lot of people forget about. And that's step number 3. Designate new beneficiaries. So if you choose to maintain it as an inherited IRA, and I see this step skipped sometimes, be sure to name a new beneficiary in case you pass away before you distribute all the money out. We don't want to end up having this money go into an estate. Number 4, can't stress this enough. Consult a tax advisor. Connect with a financial professional to discuss your specific situation, because everybody's situation is different, and help them put together a strategy for managing this inherited IRA. Once you do that, you're going to go on to step number 5, which is create a withdrawal plan. Based on the distribution rules, decide when and how much you want to withdraw. Factor in the tax consequences of that. That's the key part of why you want to develop a withdrawal plan. The worst case scenario is to just say, oh, just give me the money. It might be the best situation depending upon your particular individual tax situation, but it could really trigger a big tax issue. Number 6, seek guidance on investing. So if you want assets to continue to grow tax deferred, you got to work with an investment advisor to give you a good option of what to do with those assets. And this one is very important. This is step number 7. Maintain proper documentation. Keep records on all IRA transactions, taxes paid on distributions, and any other supporting document information. Because at the end of the year, you're going to come and see your tax advisor. I see these routinely in my practice. You got to bring all the documents. You're going to get a 1099-R at the end of the year, which shows how much money you took out. On that 1099-R, it's going to show the taxes that were withheld. The truth is, folks, the more you're informed, the easier this process will be. It's a tough time to begin with, right? You just lost a loved one. But you got to seek guidance from financial and tax professionals when you need them. So before we wrap up today, I want to remind all of our listeners to visit our podcast page. I mentioned that a time or two. That's at askralphpodcast.com. There you can leave a review, share your thoughts, and even send us a message with questions for future episodes. There's a microphone in the bottom right corner. Click on that, record a message. You can send us an email. And while you're there, join our email list to enter into our weekly $25 Amazon gift card drawing. You don't want to miss that, folks. We're giving away weekly a $25 gift card. Well, why are you doing that, Ralph? Well, I'm trying to build listenership. I'm trying to connect with the listeners so that I can let them know when things are going on the show. And as I mentioned, if you have a situation that you need expert professional advice, you can book an appointment with me right there. That's at askralphpodcast.com/store. And I can sit down with you. If it doesn't matter where you live, with Zoom, we can do it from wherever you are. And I can give you some specific advice suited towards your particular situation. So let's recap. Inherited IRAs can seem daunting at first glance, but now you have a much deeper picture of what they are and how they work. The key is understanding the distribution options, the tax implications, and steps to take if inheriting one. Use this knowledge to manage your inherited IRA intelligently. So in closing, as always, visit our podcast page for more resources about this topic. Feel free to reach out with any questions. These IRAs don't have to be confusing. Well, thank you for joining me today. Let's continue our journey grounded in faith. Stay financially savvy and God bless you.
Thank you for joining us on the Ask Ralph podcast. And with a simple click to subscribe, we'll invite you back to our next episode. And remember, financial issues don't have to be complicated. Just ask Ralph. The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media, Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.